In this chapter we're going to look at a number of discussion areas that relate to valuations. Strategically, what sort of synergy do you think you can enjoy when you buy another company? How are you going to finance it? How are you going to deal with post-integration issues? Could there be any regulatory issues that need to be managed? And finally, if a company wants to go the other way and split itself up, if it feels it's too big, how can it best do that? Exit strategies. All of these areas are commonly tested, normally as discussion areas, but there are two numerical examples in this chapter, and you need to go through them very carefully because they're important too.
Section 1 uses the example of Kraft Foods' proposed acquisition of Cadbury Schweppes in 2009 to debate the reasons for an acquisition. A sound acquisition will generate extra cash flows. These are called synergies, and typically, as lecture example 1 shows, there are three types of synergy: sales, generating extra revenue; cost, reducing your cost base; and finally financial, which is typically risk reduction. Sales synergy will sometimes mean that you can share brand names. Sometimes it will mean that you can share sales facilities. In this example, it's most likely to mean that you can share your distribution network and your relationships with key customers. So Kraft felt that they had better relationships with major retailers in the UK as well as in the US, whereas Cadbury's have very strong relationships and distribution networks to small retail outlets in the UK, and also have very good distribution networks in some growing countries in Asia. So there's the opportunity to sell each other's brands through these networks and relationships. These are all examples of possible sales synergies. Both companies in this example are manufacturers, so there might be obvious ways of sharing their cost base. For example, they might be able to close down some shared head office functions, such as information systems, procurement. They might be able to squeeze better prices from their suppliers. They might be able to share production facilities. They'll also be able to share know-how and perhaps improve the quality of their business processes. These cost synergies are particularly likely given that both companies are in the same business areas. Finally, both companies are likely to enjoy some of the benefits of risk reduction that might be expected, because when they come together as a group, the group will operate in a broader range of countries with a broader product range than the two companies have individually. This might be expected to feed through into a lower cost of capital if the group is seen as having lower risk. However, another factor here is going to be gearing, and as we'll see later, Kraft Foods has quite high gearing, and this potentially exposes Cadbury shareholders to higher financial risk, and this might raise their cost of capital. The second part of lecture example 1 goes on to look at whether your chosen target is likely to experience working relationships difficulties with the company that's taking it over. In the example that we're looking at, there could potentially be working relationship difficulties because the two companies are based in different countries and so are likely to have different cultures and sometimes, although not in this example, different languages, different strategies. And as you try to align your target company with the work processes and values of the company that's making the takeover bid, this can often generate conflict and difficulties. This is more likely if it's a hostile takeover.
As well as thinking about the strategic logic of a takeover by focusing on synergies, You should also think about the attitude of the stakeholders involved in the takeover. A takeover is not going to be feasible if key stakeholders object. Shareholders in the company that you're buying may be dissatisfied if you intend to change dividend policy or gearing. If they're dissatisfied, then they might dump their shares after the takeover, which might cause a reduction in the share price. Your customers might fear integration issues if you take over a big rival or another big company. You might find, therefore, that you lose key customers because they think that you're going to be spending your time integrating another company into your group structure. Finally, your staff, either in the company making the bid or in the company that you're taking over, may leave if they fear redundancies, and all of these issues need to be carefully managed. Before proceeding with the bid, a company needs to think about financing, and you'll be asked to comment on this in exam questions. There are two main ways that you can finance an acquisition, either by buying the shares in the target company with cash and then cancelling those shares, or buying the target company shares with your own shares, which is called a paper bid. Let's start with cash bids. The basic motive for buying with cash is that you can buy shares without diluting the control of your existing shareholders. So often it will be popular with them. And for the company that you're buying, they're going to get a definite amount of money, which hopefully will give them a substantial capital gain. So while it will be popular with both sets of shareholders, the issue is, can you actually get hold of the cash? If you don't have it, you're going to have to, presumably, borrow it or go for a rights issue, and this can create problems and expenses. We'll have a look at some of these issues in lecture example 2. For a fairly small bid, it's likely or it's possible that you'll have the cash on account and you're ready to go. But for any sort of substantial bid, it's very unlikely that you'll be carrying that amount of cash in your bank account, and therefore you'll have to think about how you're going to raise the finance. Now, whether you go for a bond issue or a rights issue may lead you into a discussion of gearing, which we've had before in chapter 9. An additional issue here is that if you go for a major bond issue or rights issue, it's going to be a signal to the world that you're about to do something with the money. And it will become apparent quite quickly that you're going to buy another company. And at that point, all of the companies that you might be thinking of buying will see their share prices go up as speculators buy shares anticipating a bid. So wherever possible, you'll go for a line of credit rather than an immediate bond or rights issue. A line of credit is a short-term agreement with a bank that will allow you funds for a short period of time to allow you to complete a takeover. And during that time period, you can organise a bond or a rights issue. So you could sign up for a line of credit, nobody will know about this. You can then use the short-term funds to buy the company with a cash bid, and then before you have to repay the funds, you organise a bond or rights issue. Let's have a look at a recent example of a cash bid. EDF supplies 80% of France's electricity and have a strong financial base and lots of experience in building nuclear power stations. British Energy supplies a fair chunk of the UK's electricity and has sites available for development, particularly for nuclear power. British Energy has been partially owned by the UK government. The UK government wants to reduce its dependence on overseas oil and gas. British Energy lacks funds, so there's a natural synergy here for EDF to come in and buy British Energy, and they did this in 2008, and in 2008 they made a 12.5 billion cash bid, and that allows them to take over British Energy. They've got the cash, the British government needs the cash, and there's a natural logic for a cash bid here. Now, if debt has been used to raise the cash required for a takeover, you might be asked to use the adjusted present value method in a takeover context. Now, we looked at this in Chapter 13 as a two-step approach, where in Step 1 you look at the investment as if you had used no debt finance, and Step 2 you adjust the financing effect because you save tax as a result of borrowing the money. To help you in the exam, you're given a formula where VU stands for the value of the acquisition if ungeared, and TB stands for borrowing, B, times the tax rate, T. And what the formula gives you is the value of the company that you're taking over as a geared entity, debt plus equity. We'll apply this formula in lecture example 3. In the lecture example, we're a company thinking of taking over Company C. Currently, we don't use any debt finance, but because of the acquisition, we're thinking of borrowing some money, quite a lot of money. So this is a major investment that would change our gearing, and as a result, we're going to evaluate it in requirement A using Modigliani and Miller APV theory. Okay, so using the formula, let's start off by looking at the value of the company after the acquisition, assuming that it had no debt. We're told in the question that after the acquisition, earnings are forecast to be constant at 254.1. We're also told that DWS, currently ungeared, has a cost of equity of 9%. So we can treat the earnings figure as if it's a dividend. There's no growth, so we can assume that all of the earnings are being paid out as a dividend and nothing is being reinvested. And on that assumption, with an ungeared cost of equity of 9%, then 254.1 over 0.09 gives a value of 2823 if ungeared. Now we can go on to have a look at the benefit of borrowing. Tax in this example is 25% and we're borrowing 500. The 125 that results is the present value of the tax saved because we're using debt finance. And I can show that just by doing a little bit of extra workings here, just to build your understanding, but you don't need to reproduce this in the exam. The interest that you're paying on the loan is 25 million each year. And if the tax rate is 25%, it means that the tax that you save each year is 6.25 million. The present value of that, going to infinity, and discounting at 5%, well, that gives you the 125 that we'd calculated earlier. So whenever you're using T times B, you're calculating the present value of the tax saved due to the debt finance that you've used. So the number that results is 2948, but we've got to be slightly careful because that includes the value of the equity plus the value of the debt. And if I want to know the value of the equity, I got to subtract the 500. And that gives me a post-acquisition value of the equity of 2448. And I can show that that's better than the situation before the acquisition, where I had 300 million shares at $8. So as a result of the acquisition, shareholder wealth would appear to be higher. I can also use Modigliani and Miller theory in part B, where I have to show the impact on the cost of equity, first of all, of the acquisition, and the acquisition has changed our gearing. So I can use a Modigliani and Miller theory for the cost of equity that you've seen before. In this formula, I have the cost of equity ungeared, which is 9. And I'm borrowing at 5. As a result of the acquisition, my debt will be 500, and the tax rate in the example is 25%. The value of the equity I have from part A. And if I work this through, it should give me a figure of 9.6%. My cost of equity has gone up because I've taken on debt finance. We know that that happens. But with Modigliani and Miller theory, I should see that my weighted average cost of capital goes down. And if I slot this cost of equity figure into the standard formula for the weighted average cost of capital, using my value of equity and my value of debt post-acquisition, then I can see that my weighted average cost of capital falls from 9% before the acquisition to 8.6% after. In part C, I'm asked to show what would have happened if the acquisition had been all equity finance. So let's imagine that we'd had the cash. I know from part A that if the company is all equity finance, then after the acquisition it's worth 2823. And if I'd had to pay 500 for the shares, then this would be 2323. Comparing that to part A, in part A, the value of the shares is 125 higher, and that 125 is the present value of the tax shield. So these numbers would appear to show that you're better off using debt finance, but that's because we're using Modigliani and Miller theory. Some takeover bids, particularly larger bids, are difficult to fund purely with cash. So it's common to offer at least some shares to buy the shares in the company that you're taking over. This could be a 100% paper bid, or it could be a mixture of cash and paper, as was the case when Kraft took over Cadbury. Paper bids can help the target shareholders to avoid capital gains tax, because they can sell some of the shares that you've issued in each tax year, in a number of tax years. One of the uncertainties with a paper bid is what will happen to the share price after the acquisition, because there will now be more shares in issue. And we're going to have a look at this in the next lecture example.
It will be helpful to work through this lecture example together. In the first part of the question, we're asked to calculate the terms of the paper bid. We're told that there's going to be a premium of 30%. This means that we're going to offer £7.48 of our shares, but we're an American company. We've got to be careful when we convert into dollars to multiply by the exchange rate, so we're going to offer 12.34 approximately of our shares. And our shares have a share price of $28. So the current proposal is to offer 0.44 of a Kraft share for every share in Cadbury. So as a result of this takeover bid, many more Kraft shares are going to be in issue. So we need to be very careful, because the effect of this could be to dilute Kraft's share price. This is one of the difficulties of evaluating a paper bid, and the way to get a handle on it is to try to estimate the value of the group post-merger, and you can see that wording in part B. And then when we've worked out the post-merger value of the group in total, we can divide by the number of shares and we'll have the post-merger share price. And once we have that, then we can evaluate whether the merger is a success from Kraft's viewpoint and from Cadbury's viewpoint. In valuing a company post-merger, you might use any of the principles of business valuations that you looked at in the previous chapter. In this example, we're going to use price to earnings ratios to value the group post-merger. Let's have a look at the issues. Okay, so let's start by calculating the price to earnings ratio of both companies. The way the lecture example is set up, the share price and the earnings per share are next to each other. So to work out the PE ratio, we just have to divide the share price by the earnings per share in both cases. And that will give us PE ratios of 19.72 for Kraft and 27.38 for Cadbury. So in this situation, the company making the takeover bid has a lower price to earnings ratio. Now when we've looked at price to earnings ratios before, we've said that they reflect the growth potential and the risk of the company. So when we think about the growth potential and the risk of the group post-merger, we have to make an assumption about what the price to earnings ratio would be. Now if Kraft Foods had had the higher price to earnings ratio, so if the ratios had been reversed, then we could have used the higher PE ratio to value the whole group. This technique is called bootstrapping. It's typical to use this technique only when the two companies are in the same industry and you can reasonably assume that the company being bought will be turned round and will enjoy the higher growth prospects of the company making the acquisition. But that's not the case here, and it wouldn't make any sense to assume that the whole group had a PE ratio of 19.7, because that would then be assuming that we were taking a high growth company, Cadbury, and we were lowering its growth potential as a result of the takeover. So here, a reasonable assumption would be that the price to earnings ratio of Cadbury at 27.38 and Kraft at 19.7 are unchanged. And if we make that assumption, then we can work out the total earnings in millions of dollars for Kraft's by simply taking the EPS and multiplying by the number of shares, and for Cadbury as well, taking the EPS, multiplying by the number of shares and multiplying by the exchange rate,